Well, the conversations continue here in Davos. I'm Shereen Bhan, and joining me now is Credit Suisse Dixit Joshi. Dixit, always a pleasure. Many thanks for joining us here on CNBC-TV18. I know you're in your silent period, so you can't talk specifically about what's happening at Credit Suisse, but I do want to get a question or two in about the current restructuring and how confident you feel about that being able to sort out the troubles the bank is seeing.
Shereen, delighted to be here back in Davos again and seeing you as well. Look, as you're seeing here in Davos, we're seeing clients, we're seeing investors, we're spending time with the constituents and stakeholders that are important. On the 27th of October last year, we announced our strategy. It was a radical strategy to effectively reposition the bank. We're well on track on executing on that strategy. We'll be able to speak more to that on February the 9th when we have our fourth quarter earnings and our full year results as well. But our teams, our people, all of them very much focused on execution right now.
As you said, teams focused on execution and putting that restructuring map in operation. Your CEO, in conversation with our sister channel, did talk about the fact that outflows have started to taper off and inflows are starting in. What can you tell us about that?
Sure. Look, there were a number of elements to our strategy that were important. One is, we had announced a cost-cutting program of $2.5 billion over the next 3 years, which again we've begun implementing. The second was, a sale of certain parts of our securities businesses within the investment bank. Again, we've been progressing towards those and we'll provide the market with an update on February the 9th. And then the third was really, a refocus towards our Swiss bank, wealth management, asset management, together with the markets business that services those. And in all those respects, we'll update the market on February the 9th. In addition, we did undertake a 4 billion Swiss franc capital raise, which we completed in December, and then have been very active in the capital markets through, the tail end of last year and in the first weeks of January as well.
I don't intend to ask you specifics, but one final question on where things currently stand. How confident do you feel on the back of everything that you've decided to do, the work that's been done, the work in progress, that this is perhaps not going to end as badly as was expected?
Sure. Look, we're already executing on the strategy, and we're pretty confident in the execution and the track that we've set out right now. The key elements, as I said, were one, raising the capital that gives confidence to all of our stakeholders, whether that's bondholders, equity holders, ratings agencies, investors. This gives them all confidence, and that was an important milestone for us to have gotten done. The second is to deleverage within the investment bank to free up capital, and that was the formation of the non-core unit, which we'd established, the capital release unit, which we'd established at the beginning of this year, which we announced last October as well. So in all those respects, we're now doing what we said that we would do in October.
Well, let's talk about the challenging global macros at this point in time. What's the mood that you've picked up on here in Davos, both in terms of the possibility of a recession, the kind of recession that we're likely to see if we do see one at all, especially as far as the US is concerned, whether the worst is behind us as far as inflation and interest rates are concerned?
So as always, Davos is, depending on your perspective, a good barometer or not of what the year holds. But there have been a couple themes that we've picked up. And again, remember, this is the first winter Davos now in 3 or 4 years that we've now had. I would say the first is really around resilience. That's a word that, we keep hearing here in Davos this year. And I think what it's referring to is really national security. And what we've seen is, supply chain disruption, whether it's in the chip sector or otherwise. What we've seen is really the need for energy resilience, the need to invest in sustainability and renewables. And all of this speaks to ensuring that countries have supply chains that can work and have some redundancy built into them. And so, that's something we keep hearing about. I think the second is really on inflation. As you say, I think the worst is behind us. Certainly, as we look at the macro data now, inflation is not as bad as we would have thought for a bunch of reasons. One, central bank policies are being much more are biting now and are effective. And you're seeing that in some demand coming off, together with potentially milder winter and lower energy prices as well. So the inflation outlook now is certainly less than the worst case. And it's partly why I think you're seeing some cautious optimism out of Davos as well.
Interest rates, and it's very clear that we are now going to be in an era of high interest rates, and the world hasn't been used to an era of high interest rates. What's the impact that's likely to have as far as the asset classes are concerned?
It's a good question. I mean, we've already seen the impact of interest rates. If you look at just, rates going from, zero to the levels where we're at, whether that's U.S. Treasuries or in, European and bonds, European government bonds and bonds, what you are seeing is a rebalancing right now of asset classes across the globe. So I think that's already started having an impact. And again, we've had the fastest rate cycle increase, I think, in decades within such a short span of time with this magnitude of rate rises. And the good thing is it's already now starting to translate into, demand coming off as well. So, the market's now beginning to do the work of the central banks as well. So I think from here, I think it would be data dependent. I think the inflation outlook certainly would help if central banks chose to pause. That would be one reason, but I think it's a little early to make a call on that just yet.
Yes, I think that's what we're picking up on as well, that it would be premature to say whether we are going to see the Fed pause at this point in time. But what's the outlook as far as the markets are concerned, not just in the US, but also India?
So I think let's start with, probably India. The theme that we're picking up here everywhere we go here in Davos is certainly...
It is quite literally everywhere. It is literally everywhere.
It is. India's very much present and active here, and for good reason. If you look at, Indian GDP growth, it's likely to remain, above world averages for some time now. If you look at, I call them entrepreneurs, but really they're industrialists who have an entrepreneurial bent in India. They all have significant capex plans. And to the rest of this world, these capex plans might look quite aspirational. Actually, that's just their base case in India right now. So I think there's a number of factors in India that will continue to drive. We won't go in through this, whether that's, demographics, the leadership and the drive from the top and so on. But actually, corporate India is very confident on India. Corporate India is investing in India. There's access to capital along the way. And actually, these businesses now have significant scale and they're able to finance much of their growth themselves as well. So, we are bullish on India. Credit Suisse, of course, has a large presence in India. We have, more than 9,000 employees. I think we've been there for many, many years. And it's the second largest location for our employees as well. So, an important area for us as well.
Now, it is a strategic market for you, as you pointed out. But as part of this restructuring, how much of an impact is it likely to have on your operations in India?
So, India for us actually is a big hub in a number of respects, not just the capital markets and, enabling our wealth clients and our corporate clients to achieve their goals and, services for them. But also we have a number of service centers in India which are effectively an extension of our desks globally. And so if anything, I think India is going to continue to be very, very important for us in allowing us to deliver on our strategy globally to make the firm less complex, more efficient.
When you have conversations here, everyone seems to say that there is no dearth of capital. There is enough capital even today. The question is, where do you believe it's going to be deployed given the opportunities that present themselves?
Sure. Look, capital generally goes to where, I think there's the most certainty with the highest return. And I know that sounds like motherhood and apple pie, but that really is
where
the
it feels safe.
Safe with appropriate returns. And in that respect, Asia certainly, strikes a chord, and you're seeing a disproportionate amount of investment going to places like India. And it's not just related to this theme of China plus one now due to supply chain redundancy needed. Actually, India's already had this, growth track for some time right now, and it continues to accelerate. So Southeast Asia, India, will continue to attract a disproportionate amount. And then the United States, you've seen, a number of, government-led actions there from the center. Again, comes back to resiliency as well. And, I think that will underpin growth there as well. So you'll see capital go into that. And then I think the big theme that you are seeing globally is clearly sustainability. And the whole energy transition, certainly in our lifetimes, is maybe the biggest shift of capital that we will be seeing.
Yes, that certainly is one of the big themes playing out here. But China, and what you make of the China story at this point in time, we've gone from China ostensibly being uninvestable to now being the big tactical play. What do you make of the China story today?
Well, actually, China will be, a big driver of, I would say, global change or global growth this year for sure. The re-emergence of China from COVID is pretty important, both locally and internationally. I think what you are seeing in China is a pivot to growth now. And I think that's important for all of us globally, because China's been in the doldrums for some time. And so, we're quite encouraged by, the early signs out of China. And it seems like, this year, China will see pretty good growth.
So, as I leave you, what's the single biggest risk that you see for the markets besides, the geopolitical tensions, energy shocks, and so on and so forth, the unknown unknowns?
Look, as a CFO of a global bank, obviously I sleep with one eye open every night. I'd say, look, there's a whole.
It's not both eyes open. Are you getting any sleep at all, Dixit, currently?
There's just so much. I would say there's so much to land this year. There's clearly uncertainty on the geopolitical side, but again, as we enter this year, it's not as bad as we all thought because a number of the risk factors have diminished. They're not gone away, whether that's inflation, interest rates, as we said, supply chain, but they have diminished from where we were before. So I think as we enter, I think we can be cautiously optimistic at this stage.
Dixit, always a pleasure. Many thanks for joining us. We wish you the very best of luck with your current restructuring plans and the efforts to turn Credit Suisse around. And thank you very much for joining us here on CNBC-TV18 in Davos.
My pleasure.
Well, we will take a break. There's a lot more coming up. Don't go anywhere. We're back in a minute with more.